So this is Dale. Today's video, I want to talk about how I lost $25,960 on just 4 bull put credit spreads in 20 trading days. Now, I've been a trader for greater than 4 decades. The losses is part of the game. Losing streaks is part of the game. If you just stick with a good rock solid strategy, you'll be a winner in the long run. But I can't avoid these losses and losing streaks, and I just want to show you these trades and how I dealt with them and how I think I can correct that in the future. I am always looking at ways to improve on my performance, which is one of the best in the industries. Been a hedge fund manager, been guest speaker for a number of places. I am the stock option coach at www.optionsinfinity, which I know is the best option educational website available today. And we specialize in credit spreads. These are the 4 ugly trades that I had: McDonald's, Goldman Sachs, Disney, and JP Morgan. I entered most of them right around the same time, the end of the year, the first of the year. And with McDonald's, I had an 18 March where I sold the 250 and bought the 240 for protection. This is a bull put credit spread. Took in a credit of about $1.36. Well, by the end of January, that was a loser, and I had to get out of that and took a $1.74 loss on this credit spread. For Goldman Sachs, it was worse than that. Took an 18 March selling the 355 and buying the 345 put for protection. Took a loss on that of $5.46. Disney, we took a loss of $3.13. And JP Morgan was a loss of $2.65. These were bigger losses than I'm used to. Yeah, it happens to me too. I've been doing this for a long time. And this was a situation in the market where it dropped so fast. It's almost like you might have heard about the falling knife syndrome. Well, let me show you some of these charts and you can see exactly what I'm talking about. First of all, I want to show you that, the losses, the $1.74, the 546, the 313, and the 265 totaled a whopping $12.98, or $1,298 per contract. 20 contracts, $25,960 in less than, what was it, 20 days, less than 3 weeks, I think it was even less than that. I'll have to go back and check. Here's the chart of McDonald's, and you can see the falling knife syndrome, how it just dropped like a rock. And I just kept saying, well, there'll be a pullback. I mean, the market doesn't go straight up and straight down. Well, this was an example where the market pretty much went straight down for a number of trading days, and I just couldn't get out. I thought I was waiting for a rebound, which never happened. And that's McDonald's. You can see this is Goldman Sachs. You can see this had a gap down and then a huge gap down, and I was underwater right here. That was a big loss for me on Goldman Sachs. Disney, the same thing, how it just gapped, shot down. Usually the bull puts that I have are very conservative. They're quite a ways out of the money, but these were such quick drops. It was very difficult. And then JP Morgan was just a big gap down and then whoosh, whoosh, whoosh. So the 4 indicators that I follow are the regression channel, the measured move, Fibonacci extensions, and the 5 and 8 day exponential moving average. And let me just talk about this a little bit. This is Goldman Sachs. And when I first got in because it made a major move to the upside. It came here it came down, and then this was an intermediate high, then a higher low, and this was a higher high. That's a measured move to the upside, and that's where I entered that trade. Now, this is the green is the 5, the gold is the 8, and you can see how that went down like that. The regression channel, which is an awesome tool. This is the regression line is based on 50% of the price above, 50% of the price below for any given time period. And then the green is the plus or minus 1 standard deviation. The gold is plus or minus 2. 95% of all prices contained within the gold 2 standard deviation of this. It's a very, very powerful tool. I've been using this for a long time. So the regression channel, the measured moves, and once you have a measured move, you can put it on a Fibonacci number that shows when you might be overextended. And then, of course, the 5 and the 8. But that didn't quite help me with that falling knife. I had trouble getting out. So, and I used the 5 and the 8 with my portfolio, with my large stock portfolio. When the 5 drops below the 8, what I will do is buy a protective put to protect my portfolio. However, with options, I don't usually look at this too closely, but the more I looked at this, I said, boy, that could really help me. And then I brought in the 20-day, and I'll show you why here, because if you get out when the 5 crosses the 8, when do you get out? Do you get out as soon as that happens, midday? Do you wait for the end of the day? I've seen it a lot of times come down below the 8 and then kick back up by the end of the day. If you come here with the 20-day exponential moving average line, and this is your get out point. And if I use that now with the vertical spreads, now I have a tool to really reduce my losses. And that's the key. I let the profits roll, and I'm looking at the Fibonacci's to see when I'm overextended and when I should take profits there. But I was looking at a measured move to the downside to get out, and you'll see that it didn't happen with these. A lot of these just dropped too quickly. Enter the 5 and the 8, and then the 20 is, don't wait for the end of the day. If you see the 5 cross the 8 and then it hits the 20, that's your exit. That's your exit. So if I go back to these, well, here it is on JP Morgan. You can see that the 20 actually it gapped down. And so, but this would have been your exit. Get out at the beginning of the day. Yeah, you're going to take a loss, but not like you would have by waiting like I did all the way down. So if you exit when the 5-day exponential moving average crosses below the 8-day, at at the 20-day exponential moving average line. And this is going to happen during the day. However, you can put an alert right at that point. And especially with Thinkorswim. Now, I'm not associated with them, but I think they're a very good platform. Thinkorswim, you can put in an alert at that point, and it'll send you an alert on your cell phone, send you an alert on your email, so that you can go in and say, oh wow, it did hit the 20, the 5 crossed below the 8, it hit the 20, I'm out of these trades. Well, if I did that, look how I reduced my losses. Now I got 33 cents loss. Okay, and that's only less than 20% of the loss I took. Actually, with Goldman Sachs, I was able to take a profit. Disney with a minimal loss and hardly anything on JP Morgan. Okay, so I took the $25,960 loss and said, there's got to be a better way. And it's to get out using the 5 and the 8 and then the 20, like I do with my portfolio of my large portfolio of stocks. Apply that also to vertical spreads. Now all of a sudden I've reduced my losses to almost zero. That's the way to trade it in the long run. Now I'm really reducing my losses and I'm letting my profits run. And that's what you want to do. Now, I've been publicly releasing trades for greater than 10 years, publicly releasing them. And over that time period, I've had a 76% win rate where I win more than when I lose. And this is a positive expectation trading strategy. And now with exiting when the 5 crosses the 8 and then it hits the 20. Well, before I talk about that, this is my return on margins from the beginning of 2019 all the way to current. And the reason I like to show this is because you can see how the equity curve was going up, and this is the first coronavirus scare. This is the first coronavirus scare. And I was not in. I took some big losses there and some losing streaks. But then after that, I had a really nice run. And this is where I've just been talking about. This is the period where I realized that I need to employ what I use with my larger portfolio with my vertical spreads to try to reduce this drop. My strategy yields the highest profits because I'm looking at the Fibonacci's and I let the profits run until they are what I think are overextended. And now with the 5 and the 8 and the 20 to cut my losses, I've got a very controlled exit strategy. What I'd like you to do is come visit my website at www.optionsinfinity.com. See what I'm all about. Like I said, I've been trading for greater than 4 decades. I don't know how much longer I'm going to be doing this. I want everybody to take advantage of my knowledge. I've been a profitable trader for many, many, many years. I've developed what I believe is a very easy, simple strategy. It's a simple strategy that it takes a little bit of time for you to master it. That's why I'm saying if you become a member and you're a member for 3 months, we will give you the 4th month for free. Okay? So you're taking advantage of my knowledge. You're taking advantage of a strategy that lets your profits run and cut your losses short. And I'm giving you basically 3 months and the 4th month free, so you can not only see this simple strategy at work, but you can master it. The other thing is, as a member, We get together once every 2 weeks. I teach the webinar. It's about an hour. You can answer any questions. And the other nice thing is I send out alerts when I see a vertical spread that I'm taking. So you can earn while you're learning as you're following me and trying to master this strategy. I hope you all enjoyed this. Bye-bye now.